As I was doing market analysis, a new member mentioned that he saw me switching back and forth through the different time frames. And is that important? Is that something that he should be doing as well? Now, what I do is something called multi-time frame analysis, and I will not assess the markets without using multi-time frame analysis. I want to see what the next higher time frame is doing. That gives me a much better idea, a much better scope, a much better view of what potentially is going to happen on the time frame that I am trading. So I'm going to explain this to you and show you using this chart how I use multi-time frame analysis, and hopefully you'll start to use it too. It will help you avoid some of your losing trades when you are trading in quote unquote the wrong direction. Now, this is a 1 hour time frame. I'm going to delete one of these moving averages. Now, this is the 13, the 50, and the 200. I'm going to delete this 200, and I will add it back because with that 200, I am able to look at two time frames on the same chart simultaneously. Now, that's not something that I expect you to understand right off the bat, but I will explain it towards the end of the video. All right, so we've got the 13 and the 50, and we're going to consider this our trend. The 13 is above the 50, we've got an uptrend. The 13 is below the 50, we've got a downtrend. Now, if I take a look at this, we could see that in one trend direction, the market moves really well. So we've got the crossover down here. Let's get my pen tool out. We've got the crossover down here, and when the market moves up, it moves up fairly well. So we get these moves up. Now, when the crossover happens to the downside, we get one little opportunity and the market moves down, but this one may have resulted in a break-even type of trade. Now, when that trend turns back up, we get a nice move, and another nice move. So what's happening with this section right here? We can avoid this section by using multi-time frame analysis. Now, let's get rid of these lines and we'll take a look at this. This is the 1 hour time frame. This is the time frame that for this example I'm trading. So I'm going to be looking at the next higher time frame. I'm going to be looking at the 4 hour, and the 4 hour time frame is going to give me a better bias or trend direction that I can follow on the smaller time frame. So what we're seeing is this section of the market. Now, these are live charts. This is a current chart of a current Euro USD on the 4 hour time frame. I'm going to mark off this crossover. So we've got a crossover right here. So with this vertical line, I'll mark this off. We know that this is where this crossover to the upside is. Now, this is the higher time frame. This is the direction that I want to focus my trades on the time frame that I'm trading. Again, in this example, I'm trading the 1 hour. So I'm looking at the 4 hour for this direction. Now I'm going to go back to the 1 hour time frame and we'll take a look at that crossover. That crossover on the 4 hour happens where this line is. Now the crossover on the 1 hour happened earlier. That's always the case, but we're going to see that the crossover or the bias on the higher time frame happens right in this area now. So from here, I am only going to be looking for long trades. That higher time frame suggests that is the direction that I should be trading. And with that, we get a pullback and a market move. We get a pullback and a market move. And here we get a change in trend direction. But we know that this section on this time frame, even though it says down on the higher time frame, this section is still up. And we can take a look at that. So we'll go back and we'll mark this off as a square just so you can see how this works. We've got a square area marking off this downtrend on the 1 hour. If I take a look at the 4 hour, what we see is this section on the 4 hour is still up. We have the 13 above that 50. So we've still got technically an uptrend in this area. So taking these short trades in this zone is not the best idea. We have two time frames telling us two different things. We've got one time frame telling us to go up, higher time frame, the main time frame, the one that carries the most weight is telling us to go up, while the time frame that we're trading or the lower time frame is telling us to go short. So if I go to this 1 hour, we may get an opportunity to go short in here. We may take a little bit of a trade. Who knows if this one's going to work depending on your stop loss management. At best, we might get a 1-to-1, maybe, or we might break even on this trade. But when the price comes back around and the moving averages do cross over right in here, now we are going to start looking for those opportunities to go long because the time frame that we're trading is in alignment with that higher time frame. So from here, we see the market pull back, gives us a nice trade, pulls back, gives us a nice trade, pulls back, gives us a nice trade. So we get these beautiful pullbacks. We get these really nice stretching movements in the market because they're in the same direction as that 4 hour time frame. So let's take a look at this on something that is moving downwards. we're going to use this same section. So let's go to the 4-hour. This is going to be our higher time frame, and we are going to take a look at a market that is moving down. Now we've got lots of opportunities in here. We've got a section here, big one in here, big one here. This one is the most current, so let's mark this off. We're going to take a look at this section, and we'll mark off that crossover, and we'll mark off the end of that crossover, so that we have this little section where the 13 is below the 50 on the higher time frame. So in this little window, it is telling us that we should be looking for short trades. Now, if I go down to that 1-hour time frame, let's take a look for those two lines. We know that in between these two lines, I'm looking only for short trades, and we get some nice opportunities in here. We're not looking for long trades, and we see that same situation happened in here. Now, we don't get an opportunity in this area, but we do get trading opportunities in here that just don't go anywhere because they are against that bigger time frame. And I always abide by what the bigger time frame is telling me to do. So now we get this opportunity to go short here. We get one in here. We get another one in here. This we are probably not looking to take because we are in an overextended market. We can see the gaps between these moving averages are pretty big. When you're doing this, you still have to take into consideration proper trading etiquette, proper trading rules. Don't trade super overextended markets, no matter if that trend direction on both time frames is in the same direction. An overextended market still needs to correct and it still needs to pull back into those averages. And then as that pullback happens, we do see that we get an opportunity for a long trade in here. Now, again, this one may give us 1-to-1, but there's a good chance that we'll end up possibly breaking even or even losing on this trade. But when that market turns back around and we get those moving averages crossing down here, we get short, short, short. Now these ones don't go, but our stop loss is in no danger of getting hit. Another short, and right in here, we have the moving averages turning up. So we're not looking for any trading opportunities in this area. So the higher time frame really does rule the day. For me, I am always checking that higher time frame to make sure that it is in alignment with what I'm doing, what direction that I'm trading on the current time frame. Now, I said before that we had those three different moving averages on the chart. There's a gray one here as well. This is a 200 EMA. We've got the 13, we've got the 50, and we've got the 200. And with the 200, I can tell what's happening on the next higher time frame. These are ratios of 4. So I have a 4-to-1 ratio between the 13 and the 50. You know, really close, give or take. We've got a 4-to-1 ratio between the 50 and the 200. And if I'm looking at the 15-minute, the 1-hour, the 4-hour, those are all 4-to-1 ratios. And when you go from the 15-minute to the 5-minute, that's a 3-to-1 ratio, but you'll get a close enough idea of this. So when I'm looking at this with the three different moving averages, I can see that the current time frame trend is up. Let's get right in here. We can see that in here, the current time frame trend is up because the 13 is above that 50. We can see that the higher time frame trend is up because the 50 is above that 200. If I take a look at this on the higher time frame, what I'm going to see is that the smaller term trend is up. So let's zoom out a little bit, and we will compare that. In this section right here, we see that we have a crossover of the 50 and the 200. Now, if I go to the 4-hour, this should be very, very close to where the crossover is of the 13 and the 50. So if I go to the 4-hour, here is the crossover of the 13 and the 50. So we're off just by a candle. So we can tell very well what the next higher time frame is doing if we are looking at this third moving average. Now, this system that you're looking at is called Trinitas. It uses the 13, the 50, and the 200, and it uses it in predominantly this fashion. We get really nice trading signals using the Trinitas in this manner. And because we have three different moving averages, we can see two different time frames. We've got trend direction 1 in between the red and the blue, and we've got time frame trend direction 2 between the blue and the gray. So we've got two different time frames, and when both of the time frames are in alignment, we get the best trades. Now, when the price gets in between the higher time frame moving averages, we do tend to get a bit of a bouncing around. So you can expect that. But if you're looking for the bigger trades, you're looking for the higher probability trades, you want to be trading in the direction of that overall trend. And that overall trend is going to be shown to you on the current time frame that you're trading and also the next higher time frame. Now, this is going to work on whatever sets you use, 5-minute, the 15-minute, the 1-hour, the 4-hour, the 1-minute, and the 5-minute. Whatever your current time frame is, you're going to find that looking at the higher time frame is going to give you a better idea of what direction that you want to trade, and it's going to give you higher probability opportunities. And we can see this again right in here. If we're looking at this, let's get rid of this 200. Now I'm just rambling at this point, just so you can see though. We have this section right in here. This is the 1 hour time frame. I'm going to mark off this section. If you were to look for short trades, even though the 13 is below the 50, it says that the trend is down. If we're looking for short trades in this section, they're not going to work out very well. So if I go to that 4 hour and we take a look for that vertical line, what we can see is this little sideways section is that section we were looking at. The trend is up on the higher time frame. We've got the 13 above the 50 telling us that the short trades in this area just aren't a good idea. We see that again in here. We see that again in here. We're on the lower time frame. The price will be in a downtrend, but on this higher time frame, the uptrend is still up. So any trades that we try to take in these areas are not going to work out generally very well. So if I take a look at this on the 1 hour, just again to drive this home, this is the areas where we're looking at trends that are down on the 1 hour time frame not working out, trends that are down, and a trend that is down on the 1 hour time frame not working out, because that 4 hour time frame says that we should be looking for those long trades. All right, I hope this is valuable to you. It will make a difference. If you implement this into your trading, you are going to notice that you are on the right side of the market more often than not.